Everyone's watching the wrong crisis. For the last 2 years, the entire financial internet has been obsessed with three things. Will the Fed cut rates? Will AI stocks crash? And will the government finally run out of money? Those are the loud stories. Those are the ones that trend. But there's a quieter one sitting underneath all of it. And it doesn't involve Jerome Powell, it doesn't involve Nvidia, and it barely gets a headline. It involves a pile of debt so large that almost nobody can agree on the exact number, sitting on the books of banks you've probably never heard of, coming due over the next 24 months whether the economy is ready or not. This is the commercial real estate maturity wall, and it's the closest thing the US financial system has to a countdown clock.
To understand why this matters, you have to go back to 2020 and 2021, when interest rates were sitting near zero and borrowing money was basically free. Office building owners, mall operators, apartment developers, they all did the same thing. They refinanced. They took out 5, 7, 10-year loans at rock-bottom rates because why wouldn't you? Cheap debt was everywhere, and nobody thought twice about locking it in. It was the golden era of the loan will just get refinanced again when it's due, no big deal.
Except that assumption only works if rates stay low, and they didn't. Starting in 2022, the Fed hiked rates at the fastest pace in 4 decades to fight inflation, and that changed the math for every single one of those loans. Because those 5 and 7-year terms from 2020 and 2021 are now landing on desks in 2025, 2026, and 2027, and they're not being refinanced at the old rate. They're being refinanced at whatever the market charges today, which in a lot of cases is double or triple what the borrower originally signed up for. Let's make this simple. Meet Dave. Dave owns a mid-sized office building in a secondary city. Back in 2021, Dave took out a loan at roughly 3.5%, and the building's income covered the payments comfortably. Fast forward to today. That loan is maturing. Tenants have shrunk their office footprint because half the company now works from home 2 days a week, and refinancing the same loan now costs Dave closer to 7 or 8%. His building's income doesn't cover that. So Dave has 3 options: pump in more of his own cash, sell the building at a steep discount, or hand the keys back to the bank and walk away. Multiply Dave by tens of thousands of buildings across the country, and you start to see the shape of the problem. Here's the part that doesn't get enough attention. It's not the giant Wall Street banks holding most of this exposure. It's the regional and community banks, the ones with names you've never heard, the ones that fund the actual local economy. These smaller banks are dramatically overweight commercial real estate compared to the big national banks because CRE lending has historically been their bread and butter. When a wave of these loans go bad at the same time, it doesn't hit one bank. It hits hundreds of them simultaneously the exact same window. We already got a preview of what that looks like. In 2023, a handful of regional banks failed in a matter of days. And the panic wasn't really about crypto or venture deposits. Not fundamentally. It was about a mismatch between what banks were holding and what depositors believed those holdings were worth. The maturity wall is a slower moving version of that same story, except this time the trigger isn't a bank run on deposits. It's a bank run on collateral value.
And this is where it stops being a commercial real estate story and becomes an economy-wide story. Because regional and community banks aren't some side character in the U.S. economy. They're the ones writing small business loans, auto loans, and local construction financing.
If a meaningful slice of them are forced to shrink their balance sheets to absorb CRE losses, they don't just quietly eat the hit. They pull back lending everywhere else too, because that's what a bank under stress does. It protects its capital ratios first and worries about growth later. So picture the sequence. Office and retail loans come due at higher rates than the underlying property can support. A chunk of them default or get restructured at a loss. The regional banks holding those loans take a capital hit. To protect themselves, those banks tighten lending standards across the board, not just on real estate, but on small business credit lines, on auto loans, on the working capital that keeps local businesses running day to day. Credit gets harder to get exactly when the economy needs it to stay flowing. That's how a real estate problem quietly becomes a Main Street problem. There's a widely respected voice in this space who's been flagging exactly this dynamic for a while now. The idea that the real fragility in the banking system isn't in the giant, closely watched institutions, but in the mid-sized ones that don't get a fraction of the scrutiny, sitting on assets that are worth a lot less than the books currently say. That's the quiet warning underneath almost every regional banking headline over the last few years, even when the headline itself is about something else. Now, here's why the loud narrative, the Fed will just cut rates and this all goes away, doesn't actually solve it. Even if the Fed cuts the short-term rate meaningfully, Commercial real estate loans are priced off longer-term borrowing costs, not the overnight rate. So a Fed cut helps at the margins, but it doesn't magically undo the fact that a building's rental income was underwritten for a 2021 economy and is now being asked to service 2026 level debt costs. Lower short-term rates don't fix a broken business model for a half-empty office tower. They just soften how fast the pain arrives. And it's not just offices. Retail centers anchored by struggling chains, aging hotel properties, even some apartment complexes that overpaid during the buying frenzy of 2021. They're all facing some version of the same refinancing gap. The office sector gets the headlines because vacancy rates there are the most visibly broken, but the maturity wall touches nearly every category of commercial property at once. So what does brace for impact actually look like in practice? It doesn't look like a single dramatic crash on a Tuesday afternoon. It looks like a slow drip of regional bank earnings reports getting quietly worse. It looks like local business owners suddenly finding it harder to get a line of credit renewed. It looks like more empty storefronts in downtowns that never fully recovered their foot traffic. It looks like small banks getting acquired or shut down in ones and twos, not all at once, so it never quite becomes a single unmissable headline, just a steady hum of bad news that adds up if you're paying it. And that's exactly why almost nobody's talking about it the way they should. It doesn't have one dramatic moment to point to. There's no single crash to put in a headline. It's not a ticker symbol you can watch fall in real time. It's thousands of individual loans at thousands of individual banks quietly coming due over the next 2 years, and the system absorbing that stress in slow motion instead of all at once. That's the real risk with something like this. Not that it destroys the economy overnight, but that it grinds away at the parts of it nobody's watching. The regional bank down the street, the small business loan that doesn't get renewed, the local developer who quietly walks away from a building, until one day people look up and wonder why credit feels so tight and growth feels so sluggish, without ever connecting it back to the wall of debt that was maturing the whole time in plain sight. So no, the biggest risk to the U.S. economy right now isn't the flashy one everyone's arguing about on financial Twitter. It's sitting in loan documents signed years ago, coming due on a calendar nobody's tracking, at banks nobody's watching. And that's usually how the real risks work. They don't announce themselves. They just quietly come due.